Welcome to Financial Discretion Advised. I'm Tyler Hafford, bringing back onto the podcast. This episode is Jim Bradley, the founder here at Penobscot Financial Advisors and the Chief Investment Officer. And Jim, how are we doing today?
Tyler, we're doing really well. I've got a heater in my office and staying warm. It's a cold day up here in Bangor. I think you're down in Portland today, right?
I am down in Portland. I was hoping that in your recent trip to Florida, you'd drag some of that warm weather up here with you, but you came back to sub-zero temperatures.
When I came back and saw that it was 37 degrees and realized that that was 50 degrees warmer than it had been 24 hours before, I gave myself credit for actually dragging some warm weather up. You're welcome.
Well, yeah, yes, thank you. Thank you. Find some more of it, please. Awesome. Well, I'm bringing Jim on today to talk about a topic that I think we hear a lot as financial planners, but I don't know how much we've covered it in other content we've created. And it's this idea of, when do I know it's time for me to retire? And Jim had done a blog on that, and I want to pick his brain. Jim's been doing this for a long time, and I'm really interested to get his perspective on this. Before we dive into that, though, Jim, I do have a series of questions that I'm going to ask you to help the audience get to know you just a little bit better. I've asked some to Sam, I've asked some to Libby. There are right answers to these questions, and I'll let you know if you get them wrong. But the first one is, would you rather ski or sit on the beach?
I'd rather ski.
Okay, so we're getting active. Would you rather have a really good slice of pizza or dessert?
I'd rather have a really good slice of pizza.
Wow, all right, right answer.
Okay.
On a roll. If you could master one skill that you don't have right now, what would it be?
Now there's a toughie. Holy cow. Oh boy. Fluent Spanish.
Okay.
I mean, I'm working on it.
How's that going? We had Ola.
I can understand everything if you speak very, very slowly, but the problem is nobody speaks very, very slowly. So
I can understand them if they speak in English. So that's all right, two more. One, you could pick one superpower. What would it be?
My superpower would be it would be flying. I mean, not having to spend all the money on aviation gas.
For everyone who doesn't know, Jim is a pilot. I have flown with him, so he's a good pilot, especially when he doesn't want to throw tricks at us. All right, so we're gonna fly. Perfect. All right, and the last question that I've asked is Sam and Libby. They both had the same answer. I'm interested to hear what yours is. You have $1,000 to your name. You're not a good financial planner, so you can't shove it in the bank. You have to purchase either a stock or a bond, not an individual stock or an individual bond, just the asset class. You have to buy a stock or a bond. What are you buying?
I'm buying a stock.
Yeah.
Every day, all day.
I like it. And that was their answer too. Awesome. All right. Well, let's kind of dive into this topic. Jim, you wrote a blog, and in that blog, you started off with using your dad as kind of a good example for someone who's getting ready to retire, thinking about when is the time for me to retire. And I thought maybe you could just walk us through that a little bit, maybe his experience or what you learned as he was going through that.
Yeah, absolutely. I was writing a blog on, the topic that we're talking about today, how to kind of know when you're ready to retire. And it got me kind of doing a little bit of introspection. At the time, it was a couple of years ago, but I'm a couple of years older, but relatively similar situation. I was approaching the age that my father actually retired. He retired at age 54, and I'm 56 now. So, when we look at clients and what they choose to do as far as retirement decisions, and when we look at the industry overall, we look at kind of this. When you think of retirement age, what's the number that comes most readily to mind?
Everyone's telling you 65, right? We gotta
65, that's the number that's, it's when the software that we use, if you don't touch anything, it defaults to 65. When you talk to people, if they say that they want to retire early, it's usually because they want to retire before 65. If they say they want to retire late, it's after 65. I think it all goes back to a time in the past when, Social Security benefits reached their full amount at 65. Well, that's not the case for anybody going into retirement now. It could be because, a lot of pension plans were based on a full benefit at age 65. And that's not, most often, that's not even the case now anymore. Those old-fashioned pension plans hardly exist anymore. And when they do, a lot of times it's age 60 or 62 that you have full benefits. So yeah, 65 started to seem to me to be just kind of an arbitrary number. And when I looked at my folks, and I looked close in at my family, with my father retiring at 54 and my mother, who at the time was still working, and I can tell you that she worked up until about 3 weeks ago. She's 81 years old, and only stopped because it was absolutely medically necessary that she do so. There's a pretty broad range of what works for people. My mother would not have worked for her to retire any earlier than she did, and she didn't even want to retire when she did a few weeks ago. It came as a result of being forced into it. So early retirement, not going to work for somebody like my mom, who derives a lot of her personal satisfaction, a lot of her social interactions, a lot of her just ability to fill a day with going and doing a work that she really loved doing. She was in nursing, and she loved it. My father's the other side of that coin. My father worked in teaching, did so for a good number of years, seemed to like the teaching and the students part, really didn't like the administration part all that very much. And, at 54 years of age, he was clinically depressed. He was in a situation where he had actually built up a lot of credits from in the teacher's retirement system as a result of having, a couple of master's degrees and some military time, and was able to kind of work that in with a little bit of disability time at the end. And has never looked back. He did not want to be in a working environment. He went on to take care of his in-laws a lot, and all of my sister's children. So he's been a full-time caregiver ever since then. But I really think that retiring at age 54 saved my father's life. It was a matter of not just preference. It was a matter of necessity, and he's a happier man because of it. So yeah, when we talk about retirement, I would, the first thing that I would throw out there is to not really think in such arbitrary terms. Think about, what do you do? What would you do if you didn't work? And this is the thing that I like to get all of my clients to do before they go into retirement, is to actually just tell me, you're going to be, working this Friday and not working on Monday. What are you going to do when you get up Monday morning? And by the way, they can't tell me what they're going to do that Monday morning. I usually tell them they have to cancel their retirement. Nobody actually really does. But we try to kind of make sure that we work on that way further out in advance. So I encourage people, to think about what they want their life to look like, how long they feel they need to or want to work, and we start to work around that. And then we'll talk a little bit more, I think, about how we get into the finances of making that happen.
Yeah. I think there was a couple of things that really struck me from the blog. One, the age in which your father was able to retire, because that is substantially, earlier than a lot of folks start to consider, which was fantastic for him. And two, every time as a financial planner someone comes in, we're always, it always starts with, how much do I need to retire, or what do the finances look like, or can I retire now? But no one really starts with the mental aspect of retirement and what that means. And really, there's a few things I think going on. You're shedding kind of who you are, right? As Americans, what's the first thing you ask someone when you meet them? What do you do? Right? It's kind of your identity. And you're giving that up. And does that make sense? It sounds like it very much made sense in the way of your father, but for your mother, it seemed to be a big part of her identity and something that was very important to her. And then the other thing that, and you kind of were just alluding to it here, was that transition into retirement. A lot of times when I'm sitting down with clients who are newly retired, that transition of those first few years is really tough for them, especially for someone in just really high demanding jobs, or someone who's just kind of married to the work throughout their working career. That's a big kind of transition that I don't think is explored enough, or at least enough thoughts gone into it about what that's going to look like. And, it sounds like you're seeing similar things.
Yeah, you could probably echo back to me the idea that most people eventually in retirement, if there's one thing that I hear more often than not, it's, I have no idea how I ever found the time to work. People get really busy with all kinds of other things in retirement. But yeah, that transition, even if it's well prepared, is a major life transition, is a major life stressor. Right up there to with other types of loss. There's almost a grieving process that people go through, whether it's they're leaving an employer that they've been at for a while, or especially if they've owned a business and they're and they end up working an orderly transition out. Maybe they sell the business or something like that. But in a lot of cases, it's important to know and to be aware of and to be prepared for the idea that this is a grief process you're going to go through. It might be a grief process that lasts 30 days or 30 seconds, right. But you're going to have a little bit of a twinge when you make that big of a life change.
And and it makes sense. You've dedicated how many years to your working life. You're right. You have pride in what you're doing. It's difficult to kind of step away from that. So I'm glad that you kind of addressed that in the blog. And then the next thing within the blog that I thought was a good thing to talk about was, on the flip side of folks wanting to get out earlier, there's the folks that feel like they need to stick around for longer. Right. They need to get those extra years in it. They need to get to that full retirement age that Social Security is telling them. But a lot of times that's not necessarily the case, especially if they've been good savers and investors all the way through their working life.
Right. And I think actually, when I talk about my parents, I think they're the exception to the rule. I think most people fall into this kind of in between where they work for a while. They know that if they work longer, they're probably going to be financially better off. But if they work a shorter amount of time, they might live longer because they're going to be, emotionally and physically better off. And they fall into a pretty tough place of trying to figure out, should I work another year? Is it going to be something I need to do? Can I afford to retire right now? And obviously, this is why people like you and I have jobs. This is when a lot of people, who may not have ever used a financial advisor in the past, actually raise their hands and come to us and say, hey, I'm starting to kind of think that it's about time. I'm getting ready to wrap it up. Can I afford to do so? So they come to us, and if you read all of my blogs, you'll see that there are some out there for the mechanics of how we do these things. And one of the primary tools that we use is something called Monte Carlo simulation. And that just takes into account the fact that, I can tell you exactly whether you can retire if you tell me exactly what you're going to get for a rate of return, if you tell me how much you're going to spend, how long you're going to live to the day and everything. It's simple math at that point. But reality is life doesn't work that way. And we don't know what, there's going to be good years and bad years. You might live a long time or a short time. And, so having all that uncertainty in place, how do we actually deal with that? And we deal with that by modeling that uncertainty, and more than just kind of saying, okay, let's run through the rest of your life once. We run through the rest of people's life 1,000 times, and try to kind of put in to place what percentage probability do they have of being able to set things in motion and just letting them go through the rest of their lives and being able to make it through. Once they're above a certain percentage, and usually for most people, that's about 75 to 90% probability that we're looking for. We can say, if that percentage of the time we're forecasting that you're going to make it through, you're good to go. You can make that decision to go. So then the next thing that I find we deal with in a lot of cases, somebody will be hypothetically, they're 66 years old. They're starting to feel a little bit weary of doing what they're doing. We've come to the place where we've told them, yeah, it's fine, you can retire. And they, at that time, a lot of times the question is, I can retire, but should I retire? And they start to kind of think through, whether or not it's going to make sense to them. And, both from a standpoint of, their quality of life, their satisfaction with how they're spending their time, and their ability to live the way that they want to live. In those cases, what I find I do a lot of the times is I'll sit with that person and I'll say, you can retire now, and we can be 85% sure of your being able to make it by spending this much per month. Right. Now, if you work another year, you might be able to have that same percentage probability of success, but you can spend this much more. You can spend a little bit more per month. Yeah. And we put a number to it. And I've found that that's helped a lot of people to make the decision in one way or another. They sit there and they say, okay, hypothetically, if I work another year, I can spend another $100 a month in retirement. Yeah. Is that worth it to me? Is that year of my life of working worth the ability to spend $100 more that I might not even really need to spend in retirement? For some people, they go to it and say, $100 more. Yeah, it's not bothering me too much. I'll go another year, and that's fine. But for a lot of people, they look at that, oh, this year's only buying me that much as an increase to what I can spend in retirement. That helps them make the decision to cut it off.
Yeah, we spend so much time talking about value in dollars and cents, but there's value in earned time, right? You get an extra year of retirement. Is it worth that extra $100 a month? I think it's a great exercise to go through with people. And to go back to the Monte Carlo, just for some folks to kind of get this, a lot of folks will come in and always ask me the question, how much do I need to retire? And I always say, that depends, right? Everyone's got a different number, and it depends on lifestyle. It depends on a ton of other things going on. And we can run it through these simulations and kind of get to the end. But to your point, when we run those Monte Carlo simulations, at the end, it will show you kind of what it expects you'll have at the, when you pass away. So, it'll show you kind of average return, then it will show you bad timing. So if you have bad returns throughout retirement, what that would look like. And you have this number. And I always kind of sit with folks and say, are you trying to leave a large legacy behind? And if you're not, this number at the end, is that too high? And if we're working extra years, all we're doing is adding to that pile of money, right? We're not going to be able to enjoy it. It's just going to be part of this legacy, unless lifestyle really increases throughout retirement. That's not the goal. And I think a lot of times that can be a good indication to folks to say, oh, am I just working so I can have a big number when I pass away? Or am I working because I need it? So really interesting. Then obviously one of the big things that we run into, and I'll let you kind of talk to it, Jim, but it's just the insurance piece, right? A lot of folks who are trying to get out a little bit earlier than 65 hit this kind of roadblock. And we're finding it's difficult. It's expensive to start picking up insurance.
Yeah, that's absolutely the case. I mean, and that's why, the person who's 66 and maybe looking at working another year to 67, maybe improving their spending capability a little bit, whereas somebody who's 64 and maybe thinking of putting off to 65 might have a really substantial increase when they get into retirement, just because of the way we do insurance in this country. We do provide, semi-affordable insurance for everybody when they turn age 65. And that's not the case until you turn age 65. It's a lot more expensive, even though we've had, finally a kind of a little bit more of a stopgap in the Affordable Care Act. That's, that it's that word affordable that kind of makes me chuckle a little bit at the time when I see the actual premiums that end up coming out of these calculations. And it's not just health insurance. It's insurance against long-term care needs, that kind of custodial care down the road. We feel, you mentioned that pile of money at the end. Well, I kind of want to see a pile of money at the end. If we don't have coverage for some of these important things, we can work a little bit closer to the bone and a little bit more efficiently if, every major risk that we see out there is covered. So, it's when we look at paying for insurance, we want to make sure that people are, I see people going into retirement with huge amounts of life insurance that they're paying for. And I say, you might not really need that going into retirement. That's not essentially why it's there. But at the same time, same person might not have, again, something as basic as long-term care coverage, which is a much bigger risk in retirement. And we can certainly be a whole lot more certain of their ability to make it through without a glitch if they've got some of those questions answered before they go into it.
Absolutely. And I'll kind of close out this discussion before we get into just what's going on with the economy here to kind of finish. But two things I would ask you. One, for everyone listening, at what age, and this is a little outside of our conversation, what age do you think it makes a ton of sense to start talking to a professional? Like, I want to start getting my ducks in a row for retirement. What age should I start to do that? And two, what do you think people should be taking stock of as they're making this decision to get into retirement, right? What's going on with them to say, all right, these are signs that I'm getting closer?
Yeah, boy. I mean, the real default response there should be start as early as you possibly can. People that I'm looking back on, and doing this over the course of 25 years. So there are people who are maybe retiring today that I was working with when they were turning 40, and to a person, everything that we planned for from age 40 has not only come to pass, but probably they're a little bit ahead of where they were, because we tend to plan a little bit conservatively when we're doing these things. But nobody I've ever spoken to has ever said, after going through a planning process, gosh, I wish I had put this off a couple of years. So simple way of putting it is the earlier the better. The bald reality is that, with our firm being a little bit more, I think, accessible to younger people, we do tend to take on a younger clientele. I think that people tend to engage financial advisors, around age 60 on average. And I'm not going to say that's too late to do anything, or it's not too late to improve substantially on where you are. And it's definitely a good time to, if you haven't done anything, to make sure that you are talking to somebody who can kind of put it all into one analytical, suite of tools to be able to kind of figure out where you're doing well and to call out the potential pitfalls you might have not have taken into account. But certainly for most people, it tends to be a combination of, okay, I'm starting to make money, so that money really is starting to kind of mean something to me, and I've got the ability to afford to hire a professional to help me along the lines. And that tends to happen in the 30s and 40s.
Yeah, and like you said, our firm does, I think, it is more accessible to just younger folks. So I think we'd see a little bit of a younger demographic. But to your point, speaking with someone when you're 45 gives you a pretty good runway to start making changes before you get up to 65. If that ends up being your retirement age. At age 60, you just have less kind of adjustments that you can make to make it all work very well. Well, Jim, that was all extremely helpful. Thanks for bringing your parents into it, whether they know it or not. And Good.
I love talking to them, talking about them, and I think they watch the podcasts, so hopefully they'll be okay with my sharing all their deepest secrets.
Yeah. Yeah. And so I think my takeaway is that, retirement looks different for everyone. Making sure you have your financial ducks in a row is really important, but a personal inventory of where you're at, I think, is really important as well, as you kind of step away. But I'm going to kind of shift our conversation to what's going on in the economy right now, and get your take. I'm just interested to hear what you think. So over the last year, 2022, Fed went through this aggressive historic rate hiking cycle to combat inflation. And we're getting to a point now. And my first question to you is, what do you kind of see for the rate hikes? Do you think we're at the end of it? Do you think that there's potential more hikes down the road? Or do you think the Fed's going to just kind of pause and say, hey, what did we do? What kind of effect did we have?
Sure. I think we're taping this episode on a day when the Fed chair is speaking, and so he very well may contradict exactly what I'm saying right now. But the Fed is talking about, yeah, you're right. We've gone through about the quickest jacking up of Fed funds rates in recent memory, and maybe in history. The Fed chair does, has laid out the expectation. They have this thing called a dot plot, where they're plotting interest rates going into the future, and they say they're pretty clear on their quote unquote dot plot that they're not done raising rates, that they're going to continue to raise them a little bit more. We're at currently a target rate of about 4.75%. I think their target, what they call terminal rate, is maybe about 5.25%. And the Fed chair has not thrown out, dismissed the idea of maybe doing another half-point cut if he felt it was necessary to do so. Half-point increase if he felt it was necessary to do so. It's interesting because the market isn't saying that. When we look at the way that assets that kind of bet on these rate movements are priced at, the market's essentially saying this was the last rate hike, and that and not only is it saying that this was the last rate hike, but it's pricing in the potential for rate decreases as we go through the year. Why would that happen? It would be most likely because of the fact that we do run into a much lower inflation scenario and potentially a recession or a significant slowdown in economic activity. So parsing those two things out, slower inflation, we're certainly seeing that. The year-over-year inflation right now is 6.5%, but that's an arbitrary time period, a year over a year. I mean, over the past 3 months, we've gone on an annualized base of closer to about 3 to 3.5%. So inflation's already slowed down a lot. And it's already getting close to the Fed target if you look at it at that level. You don't need to kind of tie it into anything, further than, a few months back and kind of see that. So, and I think that the Fed is seeing that. Also, earnings are slowing down relatively substantially. Most companies have put out the expectations that we're not going to see the same kind of growth in 2023 as we did in the few years that that preceded it. There are, but at the same time, so there's a lot of good reason to expect that we might have seen rates go as high as they've been. Maybe not, completely the end, but I certainly don't expect them to go that much further up. And if things do slow down more substantially, because the Fed kind of is using an implement when they use Fed funds rates and when they use their balance sheet to use quantitative tightening. And by the way, it's estimated that the amount of quantitative tightening that they've done by not purchasing new bonds and by letting maturing bonds flow off of their balance sheet, that equates to about another 2% increase in interest rates, what they've done already. So they've been very, very aggressive, clearly trying to ward off inflation. I would say it's looking very probable that they've succeeded there. So then the next question is, how deep of a recession are we facing as we go into the middle point of this year? And does that make them actually turn the corner and start to become more accommodative by lowering interest rates?
Really interesting. Before we dive into, I want to get your thoughts on a potential recession, but I want to unpack a couple things that you had mentioned that I think are really interesting. One, that terminal rate you were talking about on the Fed's kind of plot line and where they want to get to. That's really important because, correct me if I'm wrong, we've never gotten inflation under control without getting that above where inflation was sitting, right? So essentially, plot is to say we think we can get inflation to X, and we have to get a little bit above that to drive it back down. Is that fair understanding of that?
Sure. There's a lot of that, when we take a look at, they've never gotten rates up this quickly without causing a recession. They've never gotten inflation down without getting rates up over 5%. All of those are kind of helpful to look at historically, but I always like to say, this is coming on the heels of something that is so unprecedented. This is all still the waves washing out from shutting the economy down, not only domestically, but globally, over a period of time during the first parts of the pandemic, and the unprecedented amount of stimulus that was thrown on the economy. So whereas it's really helpful to kind of know the history behind these kinds of things, I'm going to discount it a little bit this time around.
And I would add to that kind of why this is historically different too, is that we also had a group of assets that were built in a low interest rate, high liquidity environment that kind of ballooned the value of the market, and we changed the game on them. Right. And we saw that in the NASDAQ and big tech names really took a tumble through last year. It's because the environment rapidly changed on them. But additionally, this quantitative tightening is essentially a grand experiment. We've never really gone through this in this kind of, I guess, magnitude before. Right. So I think it's also a little, you had mentioned it adds almost like a 2% hike, but there is a lot of unknown with what impact that's going to have. Right? Is that?
Yeah, I think that's a fair assessment, Tyler. The whole idea of using the Fed's balance sheet as a tool to, kind of move the economy happened pretty much for the first time in the great financial crisis in 2008, when QE, or quantitative easing, came through, and then there was QE1, and then there was QE2, and it went on to kind of QE infinity until it wasn't QE anymore. It started to tighten up, just kind of going up right up in the years coming up to 2019. And that was a little bit of tightening. This is tightening in a way that we've never kind of tried out before. And I think that, we're still, we've hit a brake pedal that doesn't, engage right off the bat, and we've hit it pretty hard. So we're going to see how much this kind of, puts us into a skid throughout the course of this year. And it's really hard to say. I mean, there's equally good arguments, I think, on both sides when it comes to, man, we've hit the brakes so hard, we're really going to hit a hard recession here on one side of it. And then on the other side of it, we've never been kind of in a situation where corporate balance sheets, consumer balance sheets, the jobs market, everything is looking so good going into a period of tightening. So like I said before, throw out the playbook, I think, and just kind of hold on for what's likely to be a bit of a bumpy ride as the market tries to figure out where this thing goes.
Yeah, before I get to that $1 million recession question with you, you brought it up, and Chairman Powell mentioned this in his last speech, that this is such a different animal than what we've seen historically with inflation. And the response has been historically different than how we've approached it in the past. So it's easy, it is kind of bash the Fed. I'm very happy I'm not sitting in their shoes right now. A pretty tough thing to have to navigate. But I'll ask you, they've done this tightening. There's a potential pause here in the near term. We're doing all this quantitative tightening. But we do have, like you mentioned, strong labor market. We do see some wage growth out there, things that aren't really consistent with a really deep, dark recession. One, do you think we see a recession here? And two, are you leaning more in the camp of the 90s style recession or an 08, 09 recession? And I won't hold you to any of these answers because I understand all this can change pretty rapidly.
Thank goodness. I'm already trying to wriggle my way out of the pizza thing because I wanted to have the dessert after the pizza. But
right, Jim. Got that right. Don't backtrack there.
When we're looking at again, a situation where we're so so strong in so many areas, I think that there's a reasonably decent assumption to be thrown out there. And I would definitely kind of fall on this side of it to say that if we have a recession, and I think we will, I think there's a pretty good chance that let's say 2 out of 3 shot that we see something that actually qualifies as a recession, not just the GDP numbers being negative for 2 consecutive quarters, but potentially tying that in with earnings going down substantially, and potentially with jobless numbers increasing to some degree. All of the things that the National Bureau of Economic Research, kind of uses as criteria to actually call something a recession. I don't see it being as bad as the 2008. I think it's more in line with your kind of garden variety recession. Right now, I'd say that the market is pricing in pretty fairly a very mild recession. So if it got worse, it wouldn't have to be 2008 bad. If it got just a little bit worse than what's being priced in, we could see some more downside movement in markets this year. But there's still that part of the market that's pricing in some probability that inflation comes down. Like I said, that's starting to show up, I think, a little bit surprisingly to the degree that it's slowing down. We might get to pretty close to the Fed's target by the end of this year. And if they can do it with a economy that's robust enough, with a jobs market that's robust enough to not get substantially damaged by then I'd say that part of that market that's moving it kind of, in the upward direction a little bit lately might be the part of the market that's right. And so we wouldn't ever want to have somebody, go into this year saying, okay, recession, time to get wickedly conservative with a portfolio. And we certainly wouldn't want them to say, okay, we got through a bear market last year, let's put everything on black and, just go for broke with the investments. It's still prudent allocation, makes a lot of sense, and kind of having a little bit in each camp. Bonds, which should do very well if we have a recession and interest rates go down, equities and other types of alternative investments that should do actually really well in certain sectors if we don't hit a big old divot.
Yep. Well, awesome information. And just kind of to what you were just talking about for anyone listening is, typically when you see that garden variety recession out there, you tend to see a 25 to 30% decline in the market, which is consistent to what we saw last year. If it is going to be deeper, to your point, you see more of a drop of like 45%, which would you'd argue that the market has some more pain to feel if that's going to be the case. Really interested to see what kind of happens over the coming months and how the Fed navigates this stuff. Hopefully inflation keeps moving in the right direction. But Jim, I want to thank you for coming on today. Anyone who would like to read Jim's blog, it's on our website under PFA Ponderings under our Insight tab. Jim's got a ton of great content out there, so please go in and find a topic you like and read it. He's fantastic at it. But Jim, thanks for coming on.
Thank you again for having me, Tyler, and hope I get invited back again to talk about something else.
Well, I'm going to think up some more intrusive questions for you, so be ready.
Perfect.
Thanks, Jim.
Thank you.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.